Our story begins with two investors. They are the same age. They save the same amount of money. They live through the exact same economic cycle. Both hold in their hands the result of years of discipline, the same amount of capital. Let's say $100,000 each. They enter the market on the same day, but this is where their paths quietly diverge. The stickman on the left chooses companies that pay him regular cash, every month or every quarter. He is a dividend investor. His goal is simple. He wants his portfolio to behave like an employer, paying him a steady salary. The stickman on the right chooses companies that don't pay a single cent in dividends. Instead, these companies reinvest every dollar they earn back into themselves. He is a growth investor. 20 years pass. At the end of those 20 years, the stickman on the left looks at his account and smiles at the long history of cash deposits. The stickman on the right sees no deposits, just a much larger number on the screen. Both are absolutely convinced they chose the smart strategy. But one of them has quietly fallen for one of the most powerful psychological traps in investing. This video is not just about dividends or growth stocks. It's about the nature of money itself. What is income? What feels safe? And why does something that looks like free money often turn out to be money you already owned? Welcome to Stickman Invests. This is the false income illusion. Disclaimer: this is not financial advice. This video is for educational purposes only. Your goals, timeline, and tax situation may be very different. Let's start with the basics. What is a dividend? When a company earns a profit, it reaches a crossroads. Path 1. It can reinvest that profit back into the business. Research and development, new markets, acquisitions, better efficiency. This is the path of growth. Path 2. The company is already large and mature. It struggles to find high-return opportunities internally. So it says, "We've done most of the growing we can. Let's return this cash to the owners." That cash payment is a dividend. A dividend-paying company is effectively telling you, "We don't have a better use for this money than you do." Now imagine a stock costs $100 and pays a $4 annual dividend. That's a 4% dividend yield. It sounds great. It feels like interest from a savings account. It feels like a bonus on top of your investment. It feels like income. But here's the uncomfortable truth. Mathematics does not accept gifts. Let's look at the math that Wall Street marketing often hides in the fine print. When a company pays you a $4 dividend, that money must come from somewhere. It comes from the company's treasury. And when $4 leaves the company, the total value of that company drops by exactly $4. The market knows this. On the ex-dividend date, the day the dividend is officially detached, the stock price adjusts downward by the dividend amount. So after the dividend is paid, you don't have $100 stock plus $4 cash. You have $96 stock plus $4 cash. Your total net worth is still exactly $100. Nothing was created. Let's make this painfully clear. You take $4 out of your left pocket and put it into your right pocket. Pause. Are you richer now? No, you just moved your own money. But here's the part most investors miss. During that transfer, someone is standing in the middle of the road, the tax man. In most countries, dividends are taxed the moment they are paid. This is critical. If you are a growth investor and your stock rises from $100 to $110, that $10 gain is unrealized. The government cannot tax it yet. Your money stays inside the investment, compounding at full power. But as a dividend investor, you lose control. The moment the company declares a dividend, a tax obligation is created, whether you wanted cash or not. Let's say you're in a 20% tax bracket. That $4 dividend is immediately hit with 80 cents in taxes. You're left with $3.20. Even if you reinvest it, your compounding snowball now starts smaller. This is called tax drag. You are essentially giving up the eighth wonder of the world, uninterrupted compounding, for a check you might not even need today. Over 20 or 30 years, this quietly erodes a massive amount of potential wealth. The growth investor compounds on the full amount. The dividend investor compounds on what's left after taxes, every single year. This is not about returns, it's about control. Now let's talk about growth stocks. Growth companies don't send you cash, they keep it. That same $4 stays inside the business and is used to expand, innovate, or dominate new markets. So what happens when you actually need money? This is where optionality matters. Imagine you have a $1 million growth portfolio. The market grows by 7%. Your portfolio is now worth $1,070,000. If you don't need money this year, you do nothing. No selling, no taxes. The entire $70,000 continues compounding. But if you need $30,000, you sell exactly $30,000. Nothing more, nothing less. You decide when to sell, how much to sell, and when to pay taxes. Think of it this way. The dividend investor is an employee waiting for a paycheck. The growth investor is the owner deciding when to take profits. If the math favors growth, why do so many investors still prefer dividends? Because humans are not spreadsheets. Markets are volatile. When prices fall 30%, the growth investor sees their portfolio shrink. If they need cash during that period, they are forced to sell at depressed prices. This is sequence of returns risk. It's the danger of being forced to sell your seeds during a winter before they have a chance to grow into trees. The dividend investor experiences something very different. Even if the stock price falls, the dividend check still arrives, assuming the dividend isn't cut. That cash flow becomes a psychological anchor. The price is down, but my income is still coming in. Dividends act like an insurance policy for discipline. They are mathematically inefficient due to taxes and forced withdrawals, but psychologically powerful. And that psychological comfort has a cost. Peace of mind is not free. At the end of the day, the market doesn't care how you earned your return. A 10% return is a 10% return. Whether it came from price appreciation or price appreciation plus dividends, the math is the same. The market is indifferent to how that value is delivered to you, but the taxman is not. The false income illusion is believing dividends are extra money. They aren't. They are forced withdrawals from your own capital. The real question isn't which strategy is better. The real question is who is in control. Real income is not just cash flow. Real income is controlled access to capital. Dividend strategies are excellent for investors who want simplicity, automation, and emotional stability, and who understand the tax cost of that comfort. Growth strategies demand discipline. You must create your own paycheck and stay calm during volatility. But in return, you gain flexibility, tax efficiency, and stronger compounding. Don't confuse movement with progress. Don't mistake familiarity for safety. Understand the mechanism. Control the taxes. Build long-term wealth intentionally. If this video helped you see income more clearly, hit the like button and subscribe for more simple Stickman finance breakdowns. This is Stickman Invests. Simple frameworks, real discipline, long-term wealth. Thanks for watching, and I'll see you in the next video.